Good afternoon, everyone. You're welcome once again to the monthly knowledge sharing session of the Young Legal Professionals Club. The Young Legal Professionals Club, otherwise known as YLP, is a group of young lawyers and young legal professionals who are domiciled in Nigeria. And the YLP is aimed at bridging together these different individuals and helping us to develop both social and professional skills that's going to make us get better in our professional career. Today, as one of the objectives of the knowledge sharing session, we, the young lawyers in Nigeria, are going to be learning about a very important aspect of our career that is going to help us in our various professional responsibilities as we discharge our obligations to our various clients in our workplaces and also in some of the different briefs that we handle personally. In today's session, we are going to be talking about the financial reality of asset life. Yeah, to lawyers generally, financial accounts, since they have to do with financial assets and liabilities, and financial accounts seem to be very tricky. Um, as a lawyer myself, as a young lawyer myself, I'm very confused about anything that has to do with assets, liability, accounting, because to be very honest, I totally disliked accounting and commerce in secondary school. So in order to bridge this knowledge gap that we have, lawyers, there's a very popular joke that lawyers and numbers don't go hand in hand. But lawyers are very bad when it comes to arithmetic, mathematics, and numbers. So in order for us to address this deficient knowledge that we have an expert, a financial accountant, who is on this call with us. He's going to be taking us through the financial reality of asset life, and he's going to be talking to us for a couple of minutes, sharing information on how we as lawyers and professionals um, can balance our assets and deal with these things. And at the end of the session, we have opportunity to ask him our questions, and he's here to address all our sessions. This session is going to last, originally it was meant to last for 2 hours, but because we started 15 minutes late, it's going to be for 1 hour, 45 minutes. So without much ado, I introduce our speaker for today. His name is Awokbeba Tio, and he's a financial accountant, and he's going to be talking to us on this topic. Please, Emperor Tio Awokbeba, I welcome you to unmute yourself to turn on the camera, if you please. We can have you take us through the session. You're muted, sir. Hello, Tio, you're muted. We can't hear you. I think maybe he's having some internet difficulties. Let me try to text him to see if he can come to join us.
Hello.
Hello, yeah, we can hear you now. Thank you.
Hello. Oh, that's great. That's great. So, good afternoon, everyone. My name is Okubati Theophilus, and wherever you are listening to this session, we hope to do justice to the topic. And at the end of the session, we will have chance to ask questions, which will all be addressed. This is the greater, and I would like you to display while I run through. Much more than what is on the slide will be discussed. Slide is just to guide us. So for those who are on the call, it will be an advantage because I do not believe in reading out slide. I speak to slides. So the topic that we are discussing this afternoon is the financial reality of asset life. And our focus will be on the next slide, which is on our focus on outline. We want to understand the basic asset life cycle. We want to identify the
Hello, we lost you there for a while. You seem to be muted again.
Oh, sorry, my network is not too good. So we said the outline will be looking at understanding the basic asset life cycle. We'll be looking at how to identify the cost, asset cost from purchase to replacement. We're looking at how depreciation affect financial decision. We're looking at the risk of extending asset life for too long. We're looking at the life cycle costing to determine true asset cost. And we're also looking at planning of timely and cost-effective asset replacement. And lastly, we are looking at using asset data to decide when to repair or to replace an asset. Those are the focus area or what we call our outline. We can't talk about this topic without examining what an asset is. So if I ask, what is an asset? And we can have varied the definition of asset, but the way accountant would define it or explain it is the way I will put it to us in this session. So an accountant will see an asset as a resource that is owned.
Our speaker seems to be experiencing some network difficulties, so let's just give him a few minutes to join the session.
So earlier before the network misbehaved, I was asking what is an asset? And I said we can have varied definition, but I will speak like an accountant. So we'll be looking at the way an accountant will define an asset. So an asset, according to an accountant, is a resource that is owned and controlled.
So, can see you now, but you are muted. You are muted.
Oh, I'm speaking. I'm not muted, I'm speaking. Can you hear
Okay,
me?
we can hear you now. Thank you.
Okay, cool. Apologies about the network. I hope it can improve. So I'm looking at the third slide that is speaking to what an asset is. So I say, according to an accountant, an asset is seen as a resource that is owned or controlled by an individual or a corporation or government with the expectation that it will generate a positive benefit. And there are different classes of assets. But before I go, moderator, may I suggest to take off my camera? I don't know why the network is misbehaving. Maybe it can help us improve on the
Okay.
quality. I don't know.
Okay,
Please
I think that
permit
would be
me.
better. That would be better if you maybe turn off your camera, if it's going to give us a better reception for your order.
Okay, thank you so
Okay.
much. So I
Okay.
was talking about what a definition of asset is, and I said is a resource that is owned or controlled. In other times, it can be owned and controlled. Other times it can be owned and controlled, not just all. And now, who are the people owning or controlling these assets or resource? They could be individuals, they could be corporation or government. But there is an expectation that this resource will generate positive benefit. So if you look at that definition, you will see that there are keywords that we cannot ignore when we are defining an asset. The fact that an asset is a resource, not the fact that there must be someone who controls or owns that asset. We can't ignore that part too. The person that control or owns can be an individual, as mentioned in the definition, can be a corporation, can be government. And there's also an expectation that this resource will generate positive economic benefit. If we have positive economic benefit in our definition, that is to tell you that a resource can also generate negative economic benefit. That is, for the fact that we have positive economic benefit in that definition, it is also possible that a resource generates negative economic benefit. But an asset should be at different types of assets. Some assets are current assets, others could be non-current assets, which please permit me to subscribe to another network. I've been frustrated by this current one. It has never been this bad. Just permit me to subscribe to it. That's going to take about 2 minutes, so that I can alternate from the current one to another. I never expect that the network would be this bad. I've been pushed out and in more than 6 times. So let me try to subscribe to an alternate network so we can have a smooth session. Just 2 minutes, please. I just subscribed. My sincere apology. I just subscribed to an alternate network because the earlier one was frustrating, and I hope that will be stable going forward from now. So, once again, my sincere apologies. I was defining an asset earlier when I said is a resource that is owned and controlled or owned or controlled by an individual corporation or government, and that resource must have an expectation to generate a positive economic benefit. I'm saying that since we have that word economic positive economic benefit, have it at the back of your mind that a resource can also generate a negative economic benefit. And I will put an example to that. Take, for instance, you have a share in an organization. You invested in an organization, you have some shares. You can consider that as a resource. If at the end of the year, the company made loss and they couldn't give you dividend, your expectation of a positive economic benefit has been frustrated. You expect a return, but you never got one. To make it worse, if the market value of that share now decline, take for instance, you bought the share at 20 naira, but because they are not doing well, the share price has depreciated maybe by 5 naira. So from 20 naira is now 15 naira. Your expectation of dividend wasn't met, so you are disappointed. So you even want to sell, you even want to cash out and sell your stock, you are still going to make loss. So if you aggregate your value when you dispose at 15 naira, you've made a loss of 5 naira per unit, and that's about 25% of each. So that's an example of a situation where your resources did not produce or generate a positive economic benefit. So I was just trying to let us know that we can have a resource that failed to generate positive benefit, but for an asset, it must meet that condition. It's a resource. It must be owned or controlled or owned and controlled by someone. That someone can be an individual, corporation, or government. And that there must be an expectation that it's going to generate positive economic benefit. So that the key word that makes the definition for an asset. And now we're talking about the kinds of asset or the types of assets. We said there is a current asset, there's a non-current asset. Another word for that non-current asset is fixed asset in some older textbook. Then we have physical asset, we have intangible asset. Let me give an example to any of these classes or types of assets. For a current asset, according to accountant, they are assets that the value may not necessarily exceed 12 months. So the asset depreciates over a space of 12 months. The example of some of them are stocks of maybe consumable, your stapler, your office stationaries, all those things. I expect that when you buy them within a year, they are consumed. So these are example of current asset whose lifespan do not necessarily exceed 12 months. Then for the non-current asset, which is the opposite of current asset, these are assets that stays for a longer time, most likely 4 or 5 years, 7 years. Some even stay over that. Take for instance a building is an example of non-current asset. If there are no disaster, if there are no critical issue, some building can outlive the owner. We have several of them. So another example is a vehicle. A vehicle can, if you buy a brand new vehicle, can last you for maybe 5 to 7, 10 years, depending on the usage. It's an example of non-current asset. You have equipment, all those are manufacturing businesses that purchase large kind of equipment that help them in production. Those equipment can last for 4, 5, 7, 10, 15 years, depending on the usage and the capacity. So those are examples of current and non-current assets. And there are physical assets. The two earlier examples I've given, they are all physical example. So physical assets, when we talk about physical assets, they are assets that can be seen, touched, and those are the attributes of being physical. Then the intangible, your goodwill is an intangible asset. A business that is doing well enjoy what we call goodwill. People are willing to do business with them. They have good name, they have brand, they have visibility around. Take for instance the way Elon Musk has been pushing Tesla all around. If somebody preached to you to buy Tesla, you likely want to buy because of the visibility, and so the merit or what is attracting you to buy a Tesla is the goodwill that they have enjoyed over a period of time, or possibly the person behind the business. Or is Elon Musk? He can't fail. Is Elon Musk? I think he's a good manager. Is Elon Musk? Whatever he touches, appreciate. Those are the comfort that you have that makes you. You may not even do a thorough research about their financial. Are they making profit? Are they this? Are they that? Oh, the person behind the business is your comfort, and that's the goodwill that those kind of businesses are enjoying. A business that has a shareholder or board owner of Bill Gates enjoys such kind of goodwill. Those are examples of intangible asset. You can't put your hand to touch it, you can't see it, but you can understand it. You can feel it, but you can't see it. Those are examples of intangible assets. And now I put another definition there according to textbook ACCA. ACC is a body of accountant, chartered accountant in UK over there. So according to ACCA definition, they define an asset as the present economic resources. Remember, the first definition also puts that word resource. So present economic resource controlled by an entity. So an entity in our earlier definition was simplified. The entity can be an individual, you and I. It could be a corporation registered as a business, and it could be a government, and as a result of past events. So this definition for ACCA is closely related to the earlier definition, but I'm just trying to put us to simplified definition and the professional body definition of asset. Now that we understood what an asset is and the shape at which assets can come, we'll talk about current, non-current, physical, and intangible. We'll be looking at that first outline, which is about the basic asset life cycle. Now, let me make it clear that the asset that we'll be looking into for the purpose of this session are non-current assets, because we will discuss as if we are talking about fixed asset, non-current asset. I've earlier mentioned that they have current asset that their lifespan do not exceed 12 months, and I talk about staplers, all those paper, all those consumable that we use in an office. So that will not be our focus. We're talking about machinery, we're talking about building, talking about big fixed fitting and fixture things that can spend 5 years and above in the business, and they continue to generate economic benefits to the business. So our focus will be on fixed assets for the purpose of this session. So we're looking at the life cycle of fixed asset, or what we refer earlier to as non-current asset. So the asset life cycle represents the full financial operational journey of that asset, from the acquisition to disposal. Disposal is unnecessary other times. Disposal means that at the end of the lifespan, we are able to still generate a residual value from the asset. Some assets can end up becoming a scrap. Let me put a light to it. I'm just saying that from acquisition to the end of the lifespan, which can be disposal or replacement. So if you buy a motor vehicle and you use for 5 years and you are tired of that vehicle, your business is tired of that vehicle. Remember that earlier we said that the person that control the resources can be an individual, can be a corporation, and can be government. So if I say you, I'm trying to refer to you as individual. If I say corporation or business, I'm trying to refer to corporate, and it could be government. So I'll use those three words interchangeably, but I understand that that is the reason why I laid the foundation earlier. Who owns or control the assets? So I may use individual, I may use corporation, I may use government. Now, example of asset from acquisition to disposal. When you purchase the motor vehicle and you use that vehicle for 5 years, after the end of the fifth year, you want to replace. You are tired of the vehicle and it's still in good shape. You can still find a buyer who is willing to buy. Disposal will apply. At the point of disposal, somebody is willing to pay as much as you are asking for. You may have purchased that asset for maybe 500,000. At the end of the fifth year, you're able to recover 50,000 from disposal. That will be acquisition to disposal. You can have instance where at the end of the lifespan, you can't even get a token from it. Take, for instance, the vehicle that Anthony Joshua that got involved in an accident. God forbid, and any of our assets get involved in an accident, but it happens. Such risk cannot be overruled in a human world. If that vehicle involved in a very fatal accident and it becomes a scrap, you may not be able to generate money at disposal, or what you're going to generate at disposal may be so little or insignificant. If at disposal the vehicle involved in an accident, you will need to tow that vehicle off the road. You may need to pay damages to some of those things that the vehicle damaged at the point of that disaster. So whatever you are realizing at the point of selling that scrap may not even cover for the damage that the disaster has caused. So in that situation, we'll be looking at lifespan or life cycle from acquisition to replacement. It can be acquisition to disposal or acquisition to displacement. That's the life cycle of a fixed asset. So typically the cost that we're looking at here, the typical cost of a life of an asset starts from planning and acquisition. So at the point of buying an asset, you are planning the purchase. That's the first point. A second point, aside the planning and acquisition, is installation and commission. The third one is operation and maintenance. The fourth one is upgrade or life extension. And the last one is disposal or replacement. And I will pick them one after the other. When you wake up to say you want to get a vehicle, planning will come to your head. There are different version or model of vehicle in the market. You are thinking, should I go for Toyota? Should I do Honda? Should I do BMW? Should I do this or that? Then at the back of your mind, you are telling yourself, why should I buy a sports car? I want a regular car that takes me from my house to the office. So you cancel a sports car because you're not going to use the car for a race. You're not going to be traveling all the time. So you think sports car does not meet the requirement for the purpose of getting that car because that's stage of planning. So the same thing for a corporation. You want to get a fixed asset that will be helping you for producing maybe ice block, for instance. You want to start selling ice block. You want a machine that can help you produce ice block. So there may be varied type of machine out there. So you are looking at what you want and the available options in the market. You are looking at the option that will mostly suitable for your business. Now, based on review and feedback, the vehicle or any asset will have different lifespan. People believe Toyota to have fuel economy, and they also believe that servicing and maintenance may be cheaper. That's Nigerian balance for you. It may not be the same for UK. There may be other cars that are trusted. For the US, guys believe in Ford. Different beliefs, different review from places to place. So when you make your planning and you want to acquire, you must have satisfied your curiosity that what you are buying actually meets the requirement that you want to achieve. Remember, it could be an individual, it could be a business, it could be government. So if government is installing camera, they want to install camera. Camera in this time is not just for security, maybe to catch violators using the road, over speeding or other traffic offenders. So government is buying those cameras and they want to be sure that those cameras will serve the purpose. That is a resource that the government is investing in, and that resource is owned by the government in this situation. And they are expecting that that resource will generate positive economic benefit. So if you put those cameras around the town, in the street, and people who are traffic offender run against the speed limit, the camera captures their plate number, captures them, and give them fine, they pay. You can see, so if government is not buying the camera, maybe they need to get a camera that is going to give them clarity. You don't want to have situation where people can start disputing and say, no, it's not my car, that's not my plate number, I did not drive the car on that said day. So they want to look at the cameras in the market, camera that will meet the requirement, that can pick up plate number, possibly snap different angles of the car and the driver, such that there won't be dispute. By the time you say this is your fine on so day you have violated the traffic rule on so highway, you can't come and say it's not you because the evidence will be so overwhelming that you don't want to start arguing. So at the point of buying, they look at the planning and acquisition. What do you want to achieve to get that resource? And the options available in the market, which of the options will you be exploiting to meet up with? So a business know what they want to achieve, a government know what they want to achieve, the same with individual. That's the angle of planning and acquisition. So you want to identify your need, evaluate alternative and purchasing of the asset. The second one is installation. Some asset requires installation. Some will just be commissioning. So not all assets will require commissioning and installation, but some, many business assets requires commissioning and installation. So if you have acquired an asset that requires installation, and commissioning. Some of the sellers of this fixed asset run such after-sales service that will help you install and commission those assets, because asset that requires installation and commission, you will not be able to use them without the installation and commissioning. There's a machine they call late machine in an engineering parlance. If you buy those late machine from a vendor, they need to move it from the showroom or wherever you are buying it from to your factory. When they get to your factory, they will install it, knot it, tie it, weld it, put oil where it is necessary, and test it to be sure that it is okay before they hand it over to you that, oh, we have fully installed this machine and it's now ready for use. The same thing applies to some home appliances that may require some expertise. Um, some appliances you can buy and go and commission it at home by yourself, set it up by yourself and start using it. But some require some skills, maybe from the seller to do after sales service, and they commission it for you for before use. That's another aspect. The third one is operation and maintenance. We're looking at asset life cycle. So from planning and acquisition, we talk about installation and commissioning. Then the next one is operation and maintenance. Take a vehicle, for instance. You will buy fuel from time to time. Those are the operational costs and maintenance. You will change your brake pad from time to time. Depending on the kilometer that you have covered, you will service, change the engine oil, and stuff like that. The same thing applies to the camera that I used earlier, where government acquire camera to be able to catch traffic offenders. There could be times that the memory space in that camera will be so filled up that they will need to replace the memory, or they may need to also clean up the camera based on whether, oh, let us service this thing. So those are things that happen to fixed asset. From time to time during the lifespan of that asset, you may have reasons to maintain and run some operational costs. And that is the longest phase in the life cycle of an asset. If an asset is going to serve you for 5 years, the planning and acquisition may not be more than 3 months. You think of what you want to buy, look around for the vendor, you decide on what you want to buy, and you purchase. That may not take you more than a month or two. Installation and commission may not take more than weeks, 2, 3 weeks, or max a month. But the operation and maintenance will happen almost all through the lifetime of that asset. You will periodically maintain the asset. You periodically have reasons to check one. When you get a sound in your vehicle, you want to be sure that you are safe. Oh, let me take it to the mechanic, to the workshop, so that they can check what is making that funny sound and fix it for you. So that will happen over and over the life cycle of an asset. And that's the longest phase in our discussion. The next one is upgrade or life extension. You can upgrade an asset, or you have to extend their life. You have to extend their life cycle. Take for instance your phone. If you consider a phone to be an asset, um, for personal use, maybe you are a TikToker, your phone may be an asset for you, generating economic benefit. You can upgrade it. To upgrade could mean that you buying additional memory space. It could be that you add some features that may not come with the phone initially. Or let me use some other assets. For instance, I've been using vehicle. Let me use a warehouse for a manufacturing business. You have a warehouse, and you now notice that your production has increased. You want to upgrade your warehouse capacity. The capacity of the warehouse before maybe. Am I getting a feedback? Is that for me? Okay, I'm not sure that's for me. So we're talking about upgrade and life extension. You may want to improve the performance of an asset by upgrading it. You may want to increase the capacity of your warehouse by getting a bigger space. So that can happen in the asset life cycle. And the last part is disposal or replacement. I think I dwell much on this during my introduction. That's the last stage of an asset where you want to dispose or replace. The asset has served its purpose, it has stayed long enough in the business. And how do you know? There are signals, there are signs that will tell you that this asset is due for disposal or due for replacement. When you get a machine that is producing maybe 50,000 units of an item every day, As the year is passing by, the number of output continues to reduce because wear and tear is setting in. Before you know it, it will not be economically profitable to continue to hold on that asset. Asset that has been doing daily production of 50,000 units, at some point it will reduce to 40, at some point it will reduce to 30, at some point it will reduce to 20, maybe 15, and later 10. At that point, you do not want to keep that kind of asset. You are not getting the fullness of the value. So at that point, you will know that this asset is not economically benefit for me to keep. I need to dispose or replace them. So basically, we have five key lifespan or key, different life cycle of an asset, and that is planning and acquisition, which I said is typically a month or two. You decide on what you want, evaluate the options in the market, and go for the purchase. The installation and commissioning for specialized kind of asset that require such installation, that doesn't take forever too. The operation and maintenance is the longest phase on this circle, where you do that continually until the asset is out of your book, is disposed or replaced. We have upgrade or life extension, and the last part is disposal or replacement. So from financial perspective, asset lifecycle is not just about how long an asset can function, but how long it can operate economically and efficiently while supporting the organization. I used the word 50,000, 40,000, 30,000, and the rest for you earlier on when I said that you will know when to dispose an asset when you see that the production has diminished. Let me use a vehicle again. You have been using your vehicle and 10 liters of fuel is taking you for maybe 50 kilometers. As the vehicle is getting old, you will need more fuel to travel that same kilometer, or the tires and the rest. You will see that your frequency in the mechanic workshop has increased. You will know that, oh, I'm not getting the best on this asset anymore. It is time for me to upgrade, to dispose, or to replace. You will know because the efficiency will have reduced. The output, if it is a machine that is generating a number of units, it will reduce. You will know. So if you have been selling each output, maybe for $10, so, and you are generating 50,000 in the year one, 40,000 in year two, 30,000 in year three, you will see that your income will be impacted because you're not able to generate so much with that same asset again. And nobody will tell you when you look at your numbers, you know that continue keeping this asset is going to run you into a loss. You don't want to do that. So we'll move into the next slide after we have discussed about the basic asset life cycle. The next slide is talking about the asset cost from purchase to replacement. The asset cost is not just the cost paid at the initial period to buy the asset. For an accountant, the asset cost include that initial cost. Remember the stages. If there is a cost you spend in installation and commission, is part of the asset cost. All those operational expenses that you spend to maintain that asset, operational and maintenance costs, they are part of your cost. Now, if you had borrowed money to finance that asset, which applies to big corporations, sometimes they go into lease agreement or even borrow outrightly from the bank to purchase an asset because they strongly believe that the asset will generate economic benefit. So if I've borrowed from a bank at 10%, and I strongly believe that this asset will give me a return such that I will be able to pay the finance cost to the bank and still have adequate as profit. Oh, it's a good deal. The bank is taking 10%, asset is generating 40%. So if I pay 10% finance cost to the bank, I'm still good. I'm still going to have a reasonable markup or margin on my business. That's the finance cost. Finance cost is not a must, and it will not apply if you had used your own money to purchase an asset. That's the clarification. Initial cost will apply, operational cost will apply, maintenance cost will apply, but financing cost will not apply if you had used your own money to purchase an asset. If you had used money from the bank, a friend who asks for interest, a finance house, a leasing business that requires interest, a finance cost will apply unless the money is given to you at zero cost. If there's a zero cost, You're not paying extra, so finance cost will not apply. There's some other cost like compliance and risk cost. Take for instance, if you use an heavy duty machine and it's polluting the environment, and you are sanctioned by the government for compliance, that oh, your diesel engine heavy duty machine is polluting this area and we consider it as environmental hazard. This is your fine. You need to regulate or this or that. If you have cost that has to do with non-compliance, that will come under compliance risk cost. And the last one is disposal cost. Some assets you cannot sell it without you making them a bit attractive. If you use your car for 10 years and you want to sell, typical buyer may not be interested in buying it in that shape and form. You may want to paint it again. You may want to do some little body work to make it a bit presentable and sellable. So that way you will have disposal cost. You may also have other ways to incur disposal cost different from touching the asset. You may sell your asset via a third party system, and the third party is saying that I will help you get buyer for this asset at a cost. This asset I will help you get buyer. I have a platform, I have 1 million followers. So by the time I put the image on my platform, buyers are already coming for it. So, but I will charge you 10% of whatever we sell it. That's also a disposal cost. So disposal cost can be the amount you use to touch and change the shape to be able to sell it faster, or the amount you pay as agreed with a third party who help you facilitate the sales of that asset. So those are the costs that are associated with fixed assets from the purchase, which is initial cost. Initial cost is the exact cost you use in buying. Operational cost could be the cost you paid from moving it from the showroom to your factory. Maintenance cost is what you use in fixing it over and over and over the lifespan of the asset. Finance cost, I earlier talk about it that when you borrow money from bank or from lender at a cost, you have finance cost. But if you use your own money, finance cost will not apply. Talk about compliance risk cost, where you violate environmental pollution stops and you are given a fine to pay. Those costs will come under compliance risk. And I also explained disposal cost. We'll be looking at depreciation and how they affect financial decision. That's the next slide. Remember, we're talking about fixed assets, so we cannot talk about fixed asset without talking about depreciation. And those depreciation will have impact on financial decision. So I'm glad the last session we had, it was all around depreciation for those who are online during that time and those who have the slides shared with them. It was depreciation that brought me to this session the very first time. So depreciation is not something that is strange to us, but we'll be refreshing our knowledge on depreciation this afternoon. So depreciation is not merely an accounting entry. It significantly influences financial planning and decision making. And how? The how is what we want to look into. Remember that depreciation is charged from year to year because we believe that the asset diminishes in value as you are using it. If you buy a vehicle at 5 naira, at the end of year one, if you revalue that vehicle, maybe it has reduced to 4 naira. If you revalue it in the next year, it may have reduced to 3 naira. If you revalue it again, it may have reduced to 2 naira, depending on the depreciation method that you have adopted. A straight line method, reducing balance method, some of the year digits, and the rest of it. But the one thing is constant. The value of that asset will reduce as you continue to use it. You cannot get the same value you use in getting that asset anymore. However, there is a caveat to this statement I just made. In situation where there are inflation, you may have your asset appreciate in value, in numerical value. How do I mean? You purchase a vehicle at 10 naira. You use the vehicle for 5 years. You can still sell the vehicle at 12 naira. Not because depreciation did not happen, but because inflation or hyperinflation has happened, and the value of your asset is now looking much more better in numerical terms than how much you paid in buying it. The real value of that money has reduced. But on paper, what you sold, you bought it at 10 naira, you sold it at 12 naira after 5 years. So in that situation, we may have assets appreciating in value, not because it did not depreciate, but because depreciation happened and the economy is responding to that depreciation. Back to our slide on depreciation and how it affects financial decision. The first way is profit measurement. Remember, we said that depreciation is going to have impact on the asset by reducing the value. And whatever value of depreciation charged against an asset is going to touch our financial, it's going to be passed as an expense to our financial statement and it's going to reduce the profit. So I'm saying that under profit measurement, when depreciation is charged, it is spread across asset lifespan, and this affect reported profit. So if you have an asset that you purchase for 10 naira, and you assume that the asset will spend 5 years with your business, if you use straight line method, it means that depreciation is going to be charged two naira per year. That 2 naira that you are charging, you are going to eat your financial statement, that's statement of profit and loss account, without 2 naira, which is going to reduce your profits. So that's the impact of depreciation on profit measurement. On tax planning, people can also use depreciation to reduce taxable income. So if you want to play prank on the government and its agency, which are the taxmen, you might use depreciation for tax planning. You want to pay lower tax now, or you want to pay higher tax later. You can shape that decision by your kind of depreciation that you want to adopt. Okay, let me pay small tax now, or I want to pay high tax now. You can use depreciation to achieve that purpose. Remember that I said that different depreciation method will not give us equal depreciation amounts. The depreciation method that we have adopted will determine what we are charging. So a smart accountant will say, okay, we want to plan our tax. Let us charge more depreciation this year. Charging more depreciation means that we are going to reduce our taxable income and we'll be able to pay less tax. Or let us charge lower depreciation now, we pay high tax now, and in the future we begin to pay lower tax, depending on what an accountant want to achieve. But depreciation can help achieve this financial decision in tax planning. I earlier mentioned about profit measurement. And the second, another one is capital replacement decision. Remember that as we are charging depreciation, it's speaking to the lifespan of an asset. If you charge depreciation for 5 years, it means that we plan to replace that asset in 5 years. So capital replacement decision, when asset is fully depreciated, they may still operate, but oftentimes they hide rising maintenance and operational inefficiency. As earlier mentioned, your asset may be deemed to be fully depreciated after 5 years. It doesn't mean that it cannot be useful, but it may not be at this maximum capacity. So if you want to use depreciation for financial decision on capital replacement, you may still keep it, especially if the value of that asset has not been significantly deteriorated. You're still getting value that is reasonable for your business. Like just like I bought a car for 5 years, I bought a car that I wanted to use it for 5 years, but after the end of the fifth year, I still find the car in a good shape. It's still serving me, no problem. The significance of the depreciation has not been so huge. I can still continue using it to delay replacement because replacement is going to come at a huge cost. So you can use depreciation to work on capital replacement. Capital replacement is talking about resource replacement. So depending on how much of the value has eroded and the operational efficiency of that asset, you may use depreciation to achieve capital replacement decision if the value of that asset has not been seriously affected. And the last one is performance evaluation. Performance evaluation is talking about how management are smart enough to generate profits on the business. Some call it ROE, ROA, return on asset or return on return, return on equity, return on asset. So you can use depreciation to achieve this. Remember, I earlier mentioned that depreciation method differ and it will give us different impact on the financial. So we can use depreciation for this financial decision of achieving a significant management performance. That is, we want to report that management is doing fine. There's a depreciation method that we can use to make the figure look so excellent. And there are figure methods that we can use that will make it modest or make it look like they're not doing so well or we're not generating enough return on the investment. So these are ways where the procedure can be used to affect financial decisions. Now we're looking at the next slide, which is the risk of extending asset life for too long. I just used a vehicle as an illustration now, where I said it's still serving me a good purpose, and by such reason, I choose to extend the lifespan. I felt, oh, why should I replace it when I'm still getting something reasonable in terms of quality from that asset? So it's good, it's not a bad idea. At least you will save your money for replacement. However, we must not overdo it. If your equipment has started giving you unreasonable cost in terms of repair. Accountants keep records. So if in year one, the total money you spend on maintenance of the machine is 20,000, you are likely going to spend more money in year two for maintenance because the machine is getting old and some of the parts will need replacement or to be changed. So if what you are now spending is so much, you will now have to sit down and evaluate it. The cost of replacement against maintenance cost, servicing cost, and compliance cost, efficiency, and the rest of it. You need to look at it if it really makes sense for you to continue to extend the lifespan for too long or for you to cut your loss and replace. We are looking at extending an asset beyond its optimal economic life may appear cost saving. Which cost have you saved? Replacement cost, because you are not replacing. However, but it introduces hidden risk. In many cases, the cost of keeping an old asset running exceed the cost of timely replacement, which is what I was trying to explain, that yes, you want to keep it, it's still serving you, but be sure that the cost that you are incurring doesn't outweigh the cost of replacement. Just like we will say in our parlance that penny wise, pound foolish. You think you are saving cost, but you're actually spending much in the long run. So we're looking at escalating maintenance cost. If your repairs often increases or rise exponentially with age, what are you saving? Aggregate the cost of repairs and maintenance, you will realize that, oh, timely replacement could even be better. These are the impact of extending your asset life for too long. You have to factor it and be sure that your decision is actually optimal for the business or for yourself or a government, depending on the category, an individual, a corporation, or government. When you begin to see your asset going for repairs all the time. Today you change fuel pump, tomorrow you change carburetor, you change. So factor the cost of replacement and look at what you have spent in the last 2 years that you have extended the asset life. You will realize that you may not have saved money, rather you have spent exceedingly above the cost of replacement. So if the maintenance cost is not exponentially high, okay, you can extend the life of an asset. But if it is the opposite, then you want to consider replacement rather than extending the asset life. Another one is operational downtime. The machine that is producing 50,000 units begin to pack up. Today you call an engineer to come and work. The cost of downtime is huge. If you run a factory where you have casual worker, those guys collect money per hour. So if your machine is down, it's not their making. It is your fault that you did not provide tool for them to work. So they will get paid for those hours that are not productive. You have not spent the hour to make money, yet you will pay for those people who are casual worker who have come to work. So you look at the number of operational downtime that you have experienced as a result of keeping this asset and not replacing it. If you think that this operational downtime is largely due to the age of the asset, you don't want to continue keeping that kind of asset. You rather want to replace it timely. Another one is safety and compliance risk, which is one of the things I mentioned earlier. The asset has been generating a sanction and fine for your business. It's giving you bad image, or or things that are making your business to look non-compliant. Nobody want to fall into that area where they see your business, that business, they do anyhow. Most of the laws and regulation, they don't abide by it. You don't want to see your business in that kind of light. So older asset may fail to meet current regulatory and safety standard. If those people come for supervision and they find out that your assets do not meet some of the requirements, safety, regulatory requirements, they may sanction you. So what you are paying as fine, and the fact that your name is also going into the regulator's book, Ukuma, replace it, because it is the aggregate of this cost that we are going to put into consideration to say that should I extend the life span or not. We're not going to treat them in isolation. We're going to look at them in aggregate. The maintenance cost, the operational downtime, the safety risk, the efficiency loss, and the reputation and service risk. We're going to look at all of these factors to say that it is sense making to keep this asset, or at this point, I no longer think in the best interest of the business, we need to keep this asset because we're generating too much expense against. Remember the definition of an asset: a resource that is owned or controlled by individual or corporation or government with the expectation of generating positive economic benefit. So if you have escalating cost in maintenance, in operational downtime, in safety, in efficiency, in reputation, this will erode all your positive economic benefits. You are expected that the machine will generate 1 billion for you in income, and you have spent 1.2. When you consider your escalating maintenance costs, operating efficiency, asset and compliance, blah blah blah, you will now see that you're having minus 200, and that is no longer meeting the definition of an asset. Because if it's no longer generating a positive economic benefit for you, it has failed the definition of an asset. It must continue to generate economic benefit for you to remain to be considered as an asset. So this is the factor that we consider when we are saying that we want to extend the life cycle of an asset. If the escalating cost of maintenance, operational downtime, and the rest of it put together are still within a reasonable figure that will still make the business generate positive economic benefit, oh, you may consider replacing in a subsequent year, maybe at the year end, maybe next year. But if you are now getting negative economic benefit, you rather want to change or replace or dispose that kind of asset because the figures suggest that it's no longer making economic sense for you or for the business or for government to keep that asset in place. We'll quickly go to the next slide, which is talking about life cycle costing versus true asset cost. Life cycle costing is a method of adding up all the costs associated with an asset asset starting from initial cost to its end of life. It doesn't take into account the salvage value or residual value, the amount you realize at the end of the year that you stop using it. So life cycle costing provide a structural approach to evaluating the total cost of ownership of an asset. We have different costing, but we focus on life cycle costing because we are also looking at the life cycle of a fixed asset. So in examining the life cycle costing, we are identifying all costs across the life asset cycle from acquisition to disposal of an asset. We're going to now discount that future cost to present value. There is this formula for present value, annuity, net present value, which I think we should be familiar with. especially if we have one or two courses around it. They call it capital budgeting. But that this section is not for capital budgeting. So what you want to do is that you are looking at the asset. These are the costs that we will incur. If I discount this thing to net present value or future value, is it making sense for me? If you discount an asset from the current value, if you cannot discount future value, but you can discount present value. So if you want to do future value of the asset will have more value in the future. If you look at what you have generated over a period of time. So you want to look at discount future cost or the present value of the asset using a percentage. For you to calculate this future cost or discounted value, you are going to have an average percentage, be it 15%, 12%, 10%, because you cannot do a discount, you can't do a discount computation without the number of years, the cost of the asset, and the rate. Those are the requirements to have our discount computed. And last one is that next one is that you want to compare alternative based on the total life cycle cost. So if you want to do life cycle costing, you have not purchased the asset at this point. You are aggregating your cost. You are looking at the net present value and future value. You are looking at the alternative available to you to take a decision if it makes sense for you, especially if you are borrowing money from a finance house. I use that borrow because business, even personal and government, they involve in borrowing of money to execute capital projects. So if you are going to borrow money to finance purchase of an asset, you are looking at the rates you are paying back as interest, that's finance cost, and you are looking at this costing. If I've gotten this loan at 10% or 15%, what is my rate of return? If I get this asset at this potential value, and this is the lifespan, and this is the cost of borrowing, does it make sense for me to go ahead with this business? Those are the things that life cycle costing is going to help us achieve so that you can know if your decision is truly right or not before you actually start the business. And the last one is that you want to determine optimal replacement timing by identifying when operating and maintenance costs outweigh replacement benefits. I have stressed this one over and over and over. The moment your maintenance and operational costs outweigh your replacement benefits, you are no longer in business. If you are spending 5 naira to generate 3 naira in income, it doesn't make any economic sense. But you rather want to spend 10 naira to generate income of 30 naira. That makes sense. But if you are spending more to generate less, you are not in business, you are in charity. And the purpose of charity and business differs. So life cycle costing versus true asset cost. You want to aggregate the cost of the assets, the lifespan, the maintenance. It's going to be an estimate at this point because you have not had the actual cost may differ, but you want to use um, a fair estimation so that when you buy and you consider this operational cost, maintenance cost, this is the expected revenue I will be generating. If you discount it and compute it, you want to tell yourself if it makes sense before you go into that business, before you buy that asset for your business. If it doesn't make economic sense, you don't want to go into such venture. It's a pity I did not put a figure here. I would have loved us to do that third part where we'll do future cost and we'll do discounting. It's just applying not annuity method, net present value. There's a formula, you can put that in the Google. If you know the cost of the asset, you know the lifespan, you have your rate. With that three, you can compute net present value and it can influence your decision if the business that you want to purchase, the asset you want to purchase makes sense or not. So you are looking at the cost effective asset replacement. You want to be sure that your replacement method is effective. And how do you do that? You monitor asset condition and performance to anticipate end of life risk. How do I mean? You may have purchased an asset and say, this asset will last me for 10 years. But as you are using it, you are monitoring. You want to, moderator, you want to go to the next slide, please. I've moved on from this slide. You want to go to the next slide, please. If you are listening to me, moderator. Thank you. So I'm talking about the next slide, talking about cost-effective asset replacement. So you have purchased an asset and you think this asset should serve me for 7 years. That is your estimation. It may end up serving you for 5 years. It may end up serving you for 10 years. But what will guide your decision is monitoring of the asset. So the asset is producing, and as it's producing, is getting worn out. Wear and tear is happening. As you are monitoring, you are looking at the performance and you're looking at the production level. If at the end of the 7 year that your estimate is still serving you and there are no escalated costs in repair, in maintenance, you want to say, okay, let us try this asset for 1 more or 2 more years before we replace. But an asset that you plan that you spend 7 years may end up spending 5 years. If you work in a factory where they do day and night, all they need to do is that people work 24 hours, people work around the clock. The specification of the manufacturer may be that the asset will work 12 hours a day, 18 hours a day, 15 hours a day. But you are using the asset for 24 hours. You are running production around the clock. The asset will not spend as much year as expected by the manufacturer. So it is your monitoring of the performance that will help you to anticipate if there's an early life risk or the asset can actually outlive the estimated lifespan. Another one is that you are using life cycle costing to compare replacement cost against ongoing maintenance cost. So you look at your cost, you look at the cost of maintenance, the downtime, another factor that we put together the other time, and you're now looking at it that if I replace, what is going to be my cost? If I continue with this current model where I service it once in 3 months, where there are no serious downtime, you want to guide yourself with life cycle costing to compare the replacement cost with ongoing maintenance cost. If it makes sense to repair, and continue to manage, you want to, okay, you can still make profit running this maintenance cost. But if it doesn't make economic sense anymore, you quickly want to recommend to management that the asset need to be replaced because the cost of maintenance has outweighed the benefit that you are getting. Another one is that you want to align replacement timing with the budget. Companies, government, individuals, a serious individual, let me put it that way, serious government, serious company, serious individual always work with budget. So if you have budget as an individual or if a corporate people have budget and government has budget, you want to align your replacement with the budget. So from the day you purchase the asset, you estimate that the asset will last for 5 years and you have budgeted for replacement in the next 5 years, such that it will be easy for government or corporation or individual to put that into consideration in their finance. Because you don't want to have a situation where you ask for replacement and the management is telling you that, oh, we don't have money right now to replace. It's not in our budget. If you have factored it in the beginning that this asset is going to be 5 years and we are replacing it in 5 years, management is aware and they are planning towards the replacement. So you want to align your replacement timing with the budget of the organization, with the budget of the government, or with your personal budget to avoid emergency purchase. That's another point towards effective replacement. Another one is that you want to prioritize critical assets whose failure will significantly impact operational efficiency. Why do I say this? You have different kind of assets in the business, but they will not be of equal critical value. Some assets, when they are down, can give you a lot of headache, much more than another kind of asset. Some assets, if they are down, things can still be running. Like if your business relies on generator for power supply, if that power supply is cut off, there's a problem. Everything is down because you rely on generating power via a generator. And that generator will fuel every production from HR to accounting to factory to name it. So without that power, your business is down. So that kind of asset, you have to put it on critical impact. This asset, we can't afford not to replace it as at when due. Because when this asset is down, our business is down. Your delivery van, you want to put it in a critical impact. Alternatively, if you have a third party that can help you do delivery, you may not want to consider your van as critical because you have option. If your van is down, you have third party who have signed agreement with you to help you deliver at a cost. But if you don't have a third party that will deliver to you, your van that you use for delivery can also be considered as a critical asset whose replacement must happen as at when due. So you have to prioritize your asset in a place of priority. This asset is very, very crucial. You put it high, you put it medium, you put it low. All those low assets, maybe when there is a fault, you can always find your way around it. It doesn't have to impact on the business so much. But all those one in moderate or medium and high, you don't want to joke with it because when they are down, your business is down. In fact, those kind of things is what sack people from job. MD is giving query to you, you are answering query, you are defending yourself, you are running. Those kind of critical assets, when they are down, you know that the next meeting you need to come and defend what you are doing and why you have not reported it to management or why you have not gotten that necessary approval to replace those assets. You don't want to find yourself defending and trying to explain because it will amount to you being inefficient. And the last one is leveraging depreciation and residual value data to optimize replacement. Because you are computing depreciation year in, year out, you have an idea of the value of the asset that has depreciated, and you have an idea of the residual value. You can also use that one to prepare yourself towards replacement of a fixed asset. These are figures that you have in-house. You have your vehicle, you have your heavy duty gadget, you are depreciating them year in, year out. So you have an idea of what the residual value is, and that decision can help you in optimizing replacement decision. I will stop here and I would like us to have an answer session. Perhaps you've been listening and you have noted some things that you would like us to discuss or you want me to shed more light on. This is the time, but to make it orderly, you may want to signify that you have question, then the moderator calls you to speak. And when you speak, I listen and I will try to do justice to your question. And that's where we are right now. Thank you all for listening.
Okay, thank you very much. So, in case we have questions, you are very welcome to signify by raising your hand, and I will invite you to speak, and you can ask a question to our presenter. Thank you very much to our speaker for shedding light on this topic. Just in case you are watching on YouTube, please don't forget to subscribe to our channel so we get to get more educational content. Thank you. So, is there anyone with a question, please? Okay, I can see Humble. Humble, you're raising your hand. I invite you to unmute yourself and ask a question, please.
Good afternoon, sir.
Good afternoon.
Oh, so the question I want to ask is based on asset replacement. Asset
Okay.
replacement.
Okay.
In practice, what's a situation where the machine in the factory is actually giving an issue, continuous breakdown,
Okay.
and one aspect of the machine, let's say the packaging machine, cannot
Okay.
also package the product very well, and also a lot of breakdown, and we recorded a continuous waste.
Okay.
Then the management now called the accountant or finance manager to write a
Okay.
report based on data. If the asset is
Okay.
the asset in the factory should be replaced to a new one, or we continue to manage to get uh, a parts. So
Okay.
how will this, can a finance manager do this if they ask figures, that they want a figure to convince them.
Okay. Thank,
But this thing is
thank you.
happening exactly in my office.
I appreciate your question, and it's very, very. You spoke well, and these are things that happen around business environment. Remember that we said those data that you need for this report, they are readily available with you. How do I mean? Go to the file. The first thing, the starting point, because I wouldn't know how long the accountant has spent in the business. But let me even assume that the accountant met the asset in the business. Let's say the asset has been purchased 3 years ago and you joined them a year ago. It means that the asset has been in the record before you. So all you need to do is that find out the date of purchase. When you have the date of purchase, then you now find the file for repairs. You want to aggregate all the sum that you have incurred in maintenance and repair. Are you following my analysis, sir?
Yes, sir. Go on.
Okay. Okay. So having put together the cost of repair, you will now again, most of the asset comes with after sales service. Some of them, like a warranty, that the business that supply will say that anything that happen within 9 months, 12 months, 6 months, we will be responsible. Just to give you a comfort. But the asset may have outlived such warranty or such benefit. So when you now put all those sums together, you are now trying to convince management that it no longer makes sense for us to be doing this repair every quarter. Because in every quarter, we are spending XYZ. In a year, because a quarter is 3 months, in a year, we will have spent this XYZ multiplied by 4. In another 2 years or 3 years or whatever the lifespan that we have estimated, we will have incurred this much, and this is the cost of replacement. You can also justify by saying that some business or scrap buyer, based on our valuation, they are willing to buy this asset at XYZ, this asset at 20 naira. We will have saved ourselves the trouble of spending 10 naira per quarter. 10 naira per quarter multiplied by 4 quarters is 40. If you are thinking that the asset will serve you for another 2, 3, 4 years, when you put this figure together, it will be so glaring that we are going to replace at 100 naira. This asset has served us for this or so years. However, your justification must also consider the lifespan of the asset. What is the policy of the organization as regard the expected lifespan? If they expect the asset to spend 5 years and you are doing this justification after year one, it won't fly. People in the meeting will raise objection against you that this asset should last for 5 years. We have only spent 1 year and we are calling for replacement. Could it be maintenance culture? Could it be poor servicing? Could it be bad purchased outrightly? Could it be that? So, a whole lot of factors. But if asset is supposed to first spend 5 years and at the end of year four, you are getting bad value from it, it's almost getting to the end of its lifespan. So, it is expected. So, you want to justify that this asset has been used for 5 years, its estimated lifespan is 7 years, but because of heavy usage, we have run the lifespan of this asset. And this is what we have been incurring on operational expense, on maintenance. If there are compliance issues, factor it too. That if regulator comes around to our factory, they can sanction us. That is, there are hazards that are waiting to happen if we continue to use this asset. By the time you put all those figures together and you now put it beside the replacement cost, maybe we're going to just spend 20% more than what we will have incurred in maintenance. And this new replacement will not likely give us this running cost. Because just like when you buy a new car, you're not likely going to visit the mechanic often as when you have used it for 5 years, 6 years, 7 years. So you're going to justify your proposition by putting the repair and maintenance cost, considering the age of the asset. If it is 5 years and you have used it for 4 years, it gives you a smarter position to argue your case. But if it is asset that has not lived up to a significant figure in its lifespan, people will be questioning the earlier decision to purchase it. That we expect that this asset will be used for 5 years, we have only used for a year or two. Why are we considering replacement? Could it be that you are not maintaining it properly? You're not having that at when due or poor usage. People want to stand against you. So if if you are examining that there are no poor usage, poor servicing, all those ones are eliminated, then you can use the cost of maintenance, operational cost to justify and the lifespan estimated, the already consumed lifespan to convince management on the need to replace. So we're going to put two things before them. This is the cost of replacement, and this is the current cost of servicing and maintaining this vehicle. We are spending $60 every year. In the next 4 or 5 years, that is the remaining lifespan of this, we will have incurred this much. If we replace it now, we will not spend this maintenance cost every year because a new machine will not be heavily having escalated cost of repair. So we will save this much, or this is what we are going to. That's okay. Maybe we can put. I'm trying to look at a practical example where we can say, let me just put an hypothetical figure. You bought an asset 2020. That's 5 years ago because we have not gone far in 2026. So at the point of purchase, management assumed that it will last for us for 7 years, and we have spent 5.5 years thereabout, and you are coming to justify why we need to replace. So you will now consider the hour that you have spent it. So according to the manufacturer, this machine should work 12 to 15 hours daily. So all those seasonal period that you have exceeded the period, you are telling management that this machine should work 12 hours, 15 hours daily. But there are several instances that it has worked for 18 hours or 24 hours, meaning that we are fasting the lifespan, even though by our calendar, it's looking like it has spent 5 years. But looking at the number of hours that we have used it, we have actually consumed the 7 years. That's the justification. We are now adding together that at the point of purchase, year one, our service and maintenance cost was just $100. But at year three, we started spending $400, repairing parts, buying this, buying that. If we now aggregate what more we will spend and the cost of replacement, I think it will make a whole lot of economic sense to replace now because we are now spending escalated or exponentially increased cost in maintaining this asset. So management is looking at it from the angle of it's almost getting to the end of the life cycle. You are spending this much, and does it make sense anymore? So you can justify that way. I hope I address your question, sir.
Yes, yes. Thank you very much. Thank you very
You're
much.
welcome,
But
sir.
what of
You're welcome.
inflation? What of inflation if the accountant recommend that the asset should not be outrightly replaced? Hello.
But it should be repaired, right? Okay. It's
Yes,
recommending
that
a
they
repair,
should
not outright
invite,
replacement.
not necessarily repaired by our local engineers, but to invite the
Okay.
manufacturer
A
engineers to
vendor,
come and
okay,
rectify the
manufacturer.
fault.
That also makes sense. However, to be sure that you are getting the best from that decision, you will make the manufacturer who is coming to sign a bond on agreement that if we incur this much, it will last us for so period, so manufacturer will be very, very careful in giving you that kind of assurance. So when they check and they say that, oh, this asset, no matter how we repair it, this is the much that it can serve you. But this, so I don't know if you get my point. So you're not going to incur the cost
Yes,
and end up having the same impact. So if you want to transfer a part of the risk to the vendor by saying that we have been repairing this and we trust you to do better. If you repair it, can you give us warranty that our production output will increase, our efficiency increase, breakdown will not happen as much? When those people are hearing that kind of statement, they want to be very, very careful. So when they review, they will tell you that this machine has lasted for so long ago. This may not happen. This may not work. Even before repair, their check will expose them. So the moment they begin to turn down to say that, we can't give you that guarantee, you can go back to the accountant, that even the vendor who want to fix it doesn't have the assurance to give us. As such, repair may not make sense other than replacement.
okay.
Am I clear, sir? Am I
Yes,
clear, sir?
yes, yes. Thank you very much.
It's just like taking
Thank
my
you.
phone to Samsung to fix it for me. And I'm telling Samsung, I will pay whatever you tell me to pay. But what warranty are you giving me that this screen, no physical damage will happen or whatever? So when you're asking those kind of questions, they are careful in saying, I can beat my chest that this or that will not happen. They want to be careful because you have set them up for a possible litigation or a relationship issue that they may not want to marry. You are setting them up for straight question, non-ambiguous question. We are giving you this thing because we wanted to achieve this. If you will not be able to achieve this, please kindly let us know. So they are checking and they are giving you specific answers. They want to be careful on the kind of response they will give to you. So that response coming from a professional, when you give it back to the accountant, the professional who have checked this thing did not have the comfort that this machine can serve us for 3 more years. They also suggest that we can only manage situation. It will not significantly improve our business. So accountant will be forced to agree with you or replace it because the professional is now speaking, and that is not coming from you or the accountant. You will likely tend to believe a professional. Thank you.
Okay, thank you very much. Humble, I hope he has addressed your concerns.
Yeah, thank you, sir.
Okay, thank you. So,
Thank you, sir.
to our speaker, I would like to shift the conversation to a more professional. I'm trying to look at the synergy between law and accountancy. And for us legal professionals, most times from a professional point of view, not necessarily from a personal point of view, we are confronted with these issues of asset liabilities and depreciation when we deal with some certain kind of cases. For example, cases that have to do with insolvency issues, winding up issues, and for those of us who handle this kind of transactions, there are a number of factors that we tend to avert our mind to. And I would like you to, from your accountancy perspective, to address some of these issues. So, for example, what are the things that should make a lawyer suspicious that a company is still using old assumptions about how long assets last, even though those assets are being used regularly and they sit idle or they've been overtaken by new technology? So, basically, what are the warning signs or the red flags that indicate that depreciation of an asset is out of date based on the company's assumptions?
All right. Thank you for that question. I will share something with you on WhatsApp because if I put it on the Zoom, I'm not sure people can be able to copy it, and that will answer this question. However, I'm still going to speak to it. The accounting policy and generally acceptable standard did not confine any organization to a rule as regards how long an asset should be. There's a liberty and flexibility around it. However, there are popular that people tend to believe. For land, land is never depreciated because it is assumed that land over a period of time will always appreciate in value. So, accounting perspective, land will never be depreciated. So, if the asset in consideration in discussion is a land, no. If it is building, it is assumed. I just shared with you if you're on WhatsApp, sir, the moderator, and I'm trying to speak to them. For a building, it is assumed that building will live for up to 40 to 60 years. That doesn't mean that building cannot collapse before that time. But if you put up a good structure, a building should live from 40 to 60 years. So that guides the business when they want to factor depreciation. Now, if it is plant and machinery, like what my earlier brother talked about, factory machine, most of those machines are built to last for 10 to 20 years, depending on the kind of machine. So that these are guides. If it is machine in the workshop, some of them are 5 to 10 years. A vehicle is expected to be depreciated in 4 to 5 years. So these are general standard. So if you now have people who are putting depreciation outside this acceptable standard, you may begin to factor a possible anki-panki. But like I said, there are no rule. There are no rule for that. This is if you purchase an asset, a vehicle, for instance, and we say that it shouldn't last beyond 4 to 5 years, it is not to mean that they cannot last you 7 years. We know people who drive car for 10 years, 8 years. But business perspective, accountant perspective, you should fully depreciate a vehicle within 4 to 5 years. But like I said, the same thing applies to any of these assets. We may say that building should be disappear within 40 to 60 years. Does that mean that we cannot find building who has outlived the owner, like 100 years, 150 years? There are some ancient building that are even built in 17, 18, or 19th, and they are still standing strong. But business perspective, we want to put we cannot leave it in perpetuity. We can't. So this is just to guide us, but we can play around this. Not the, no, not no accounting rule define that it should be 5 years, it should be 4 years, but there are estimation that is globally or generally acceptable. That way, again, the approach for disposal of a business that is winding up is not the same for business that is not winding up. For business that is not winding up, they call it going concern. For business that is winding up, they call it realization. And in realization, you may not command high respect because you want to sell all those assets and close up the business. You must have gotten a court order to wind up it. Maybe you are, I think they call them executor or whatever. What's the right name? Trustee and the executorship. So you have a court order that you want to dispose an asset of a business that is no longer existing. You don't command respect. You just want to realize money, pay up the debt or debtors, and sort everything. But if it's a going concern business, they have a figure that they don't want to go below. Oh, I bought it at 1 million. I've depreciated it for 20% or 30%. I can still command this respect. If the buyer is not coming in a month or two, I can still sell it much later. But for a winding up business, as early as possible, you want to let the asset go. So the valuation will differ from a going concern to a business that is winding down. I hope I'm able to address your question.
Yes, thank you very much. You've been able to do that. And so now you talked about the differences between a going concern, a company that is winding up, and
Yes, sir.
a company that's is about to break down, or a
Oh,
going
that,
concern. Yeah. So
yeah, yeah.
I'm also thinking, like, for example, when a company stops being a going concern and it is moving towards
Winding
breaking
up.
down, bringing up, yeah. So how should a lawyer who is accountingly trained think towards rethinking asset values and long-term liabilities that are tied towards some of this aging equipment in order to recoup optimal value in the winding up proceedings?
All right. Thank you for this question. In the book of the business, they will have the asset cost and they will have depreciation. Take, for instance, you bought an asset 100,000 and you estimated that the asset will last you for 10 years. So you are depreciating the asset 10,000 every year. At the end of year five, the asset, you assume that you have spent 50,000 naira worth of the asset and 50,000 is left. So that's the book value. Now, there is book value, there is market value. So, as a result of technological changes, as a result of inflation that I mentioned earlier on, book value and market value may never agree. Take, for instance, there was a year that some phones, okay, let me use iPhone. iPhone is a very good one. Some iPhone that was selling for 1.2, 15 Pro Max precisely, it was selling for 1.2 in October last year. I priced it this year. It's selling for 1,050,000 naira, the same UK used, meaning that market price has happened to them. The same phone, the same model, in a sort of 3 months, about 150,000 thereabout has reduced in the value. So you have your asset book value. When you take your depreciation off it, you have what they call book value. The cost of the asset exists, the depreciation that you have charged exists. So the depreciation will reduce the cost to a book value. Now, when you want to sell, you don't want to sell below the book value. You want to sell at book value or above the book value to make profit. Now, market value will force you to think, "Ah, oh boy, the price I'm calling, they will not buy it, or is reasonable enough." So everybody knows that a Tokubo car is selling for around this price. So you want to put your price around the market value. So the market value will now help you to make more money in profit of the book value, or you even make less. So if at the point of buying that asset, technology has changed, maybe it's the analog kind of asset, and the world has moved on to digital kind of asset. At the point of selling, nobody want to buy a analog type. You are even forcing people to buy, or you have to take it to a primitive area to be able to sell it because people have moved on from analog to digital. So the price that you will command, regardless of the book value, the market will react to it that no, this is not in vogue again and nobody uses this again. So you even find it difficult to sell because technology changes has happened and market is reacting to a latest version of it. But if it is so that inflation has happened and you can even command double of the book value, not because the asset is better, but inflation has happened and everything in the market is going up in the upward trend. Your book value may be saying 50,000 and you are able to sell it at 100,000 because market value also exists. So market value exists, book value exists. But what you want to achieve as an accountant is that you don't want to sell below the book value. You are trying to sell at book value or above book value. But you can be forced by market value to lower your price or get more. Have I answered that question, sir?
Okay, yeah, thank you. Thank you very much for your answers. We'll be rounding up this session very soon because I really want us to keep to time, even though we started about 15 minutes late. But in the meantime, if you have any questions, feel free to raise your hands and I will invite you to ask your questions. But our speaker, I still have a couple of other questions for you, if you don't mind. So for in the past couple of 5 minutes, we've been talking about winding up insolvency, going concerns, and stopping a company. But let's talk about when
Mm.
a company is in existence, a company is viable, is doing business, is making money. And sometimes, as lawyers, we sometimes act as legal advisors in transactions that involve the purchase of high value assets. Sometimes two companies are about to merge, mergers, acquisitions, in this kind of transactions. So, in your expert opinion, what do you think are the factors or are the items that a lawyer who is advising in a big deal, probably involving acquisition of a new company or acquisition of a new technology? So, what are the must see items that a lawyer must see before he makes analysis on the life cycle cost of the asset of the company in that transaction? So, what are the check marks, the things we should look at in order to make a proper analysis of the life cycle cost of the assets in the
Okay.
company?
All right. Thank you so much for that question. I've also involved in merger and acquisition 2 times so far. So in merger and acquisition, the bigger company, because in merger and acquisition, okay, let me not even put it together. Merger is different from acquisition, but they are closely related. In merger, we think two business of equal strength or almost equal strength are coming together. So they look at their differences and they come together and find a way to align. But in acquisition, a bigger business is taking over a perceived smaller business. So in acquisition, you propose a value to the smaller business that you want to. Proposing that value, you will need an expert to review not just the books of the smaller business, but also the market value. Because the person that want to sell will be asking for higher price, if possible, to cheat you, but you are the one who is paying and you want to stay safe. So you say, okay, you have valued your goodwill at this point. What have you put into consideration for this valuation? You are dying for God's sake, so you don't have this goodwill. I don't think your goodwill is this much. You renegotiate it, you factor it. Now, the person will come and tell you that this my assets, my building in Ikoyi cost this, my building in this one. Okay, what is the market value? When did you buy it? What is the cost? What is the depreciation that you have applied to it? So most of the time, there are professionals who are called valuers. The reason why they are professional is because they have a market idea of what the value of those things are. So aside whatever, because books can be doctored for the purpose of acquisition and merger, books can be doctored. So a professional valuer will not listen to the book alone, but will also listen to what the price is around that area. The cost of a three-bedroom flat in Ikoyi may not be the same with Ikorodu. The cost of three-bedroom flat in a location will be different from the other because different exposure, different parameters will be applied. So a valuer will help you look into the books and what is the market price saying in those locations. Then you have to discount it because of possible repairs. Because by the time you pick up those equipment, some of them may not have been serviced for a long while. You are going to to discount it. Yes, it's worth 1.2 million, but I can't pay 1.2 million because I don't even know the true state of this asset. So because I don't know the state, I may be changing part, I may be fixing this, I may be fixing that. So you will discount it. Just like if I'm buying a UK used phone, I will tell you, yes, you call it UK used. What if I bought it from you and in 2 months it packs up? So you're asking for 1 million, I can't pay 1 million. I'm carrying the risk. I'm parting with money. So yes, you call it 1 million. I'm only willing to pay 850. I'm only willing to pay 900. You know that there's a market price, there's a book value, but there's a valuation around that kind of asset, which is working together with a valuer who are professionals, because that goes out of the understanding of accountant. Accountant will look at the book value, look at the depreciation, but a valuer look beyond book value. They look at what is the market commanding in that area at that point in time. Then they can now discount it. Negotiation will come in, that MOU will be signed. So it's going to be up and out. It's going to be pushed over the small bank, the small organization that you are acquiring. They are saying that no, I value it at this. I'm telling you, no, this is what the market is saying in that area. Okay, you shift grant, I shift grant, they will come to a conclusion. That is how they will evaluate different classes of assets in the books and now look at the total valuation of the business that they want to acquire. The same applies in merger. Thank you.
Okay, thank you very much. This clarifies it. It's making it sounding more interesting. And I wish we had more time to discuss some of these issues that the relationship between financial assets and legal part of our business, because many times we lawyers we act as lawyers in these
Intermediaries.
transactions, intermediaries, and even in some cases, we act as lawyers in litigation cases, and there's some analysis we have to make. I see we have a couple of questions from some of our participants. So let me invite Mr. Oluwasegun Ayola to ask his question, please.
Good evening, Mr. Theophilus and everyone.
Good evening, sir. Good evening, sir.
So I just want to ask this because I didn't come in early, but I followed through with some of the concepts that you explained, particularly as regards land. So the fact
Okay,
that
sir.
land is usually not depreciated.
Depreciated.
So
Yes, sir.
I just thought of something that imagine a company that is operating in the oil and gas sector, and maybe they
Okay.
have oil mining lease,
I like your
oil
line of
block.
thought. I like your line
So
of thought. Please go ahead.
will
Go
that
ahead.
principle still apply to like an oil block that is meant to depreciate over time, which is also land? So that's basically my question. I want to know if that whether there's another concept applicable to depreciation as per
Okay.
oil block in the oil sector.
I like your line of thought. The moment you mention oil, I begin to see how much deep you've thought about it. Yes, land will still not depreciate. In the kind of business of oil exploration, they will see it from the angle of oil block rather than land. Okay, let me also go back to the definition of asset. We call asset a resource that is owned by individual or corporation or government that they are having expectation that it will bring positive economic benefit. So now, the oil and gas that is exploring mineral resources from wherever or beneath the surface of the earth, the land will not be in their book as an asset. But the oil block where they are tapping from is their asset. Because whatever they extract from that place, they can get value for it. Now, their cost of doing business will now be all those machine equipment, blah, 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 that they are using to get those mineral resources out of the land. But in their books, they will not put that a value at that land. Rather, they will value the exploration. So, maybe if you want us to look deep into it, I don't mind preparing something. Maybe if the committee consider us to explore valuation of asset in oil, in that land will not still depreciate in their kind of business, but their kind of asset will now be the mineral resources that they are exploring from that base, their oil block, but asset will still not depreciate. They will not value it. They can put a value for for their land, what land not going to depreciate. What they will depreciate, what they will rather depreciate, because again, the exploration will not last forever, because they will get to a point where if they have been exploring 32,000 barrels per day, they continue exploring. It will get to a point that they won't be able to explore as much as they have been exploring in the years past. Depreciation has happened, not to the land, but to the resources that they are exploring. If you see it from that angle, you will agree with me that land itself did not depreciate, but the exploration that they are getting from the mineral resources will reduce over time. I hope I addressed that question, sir. Are you there? I'm not sure.
Yeah,
Are you
thank you.
there?
Mr. Oluwasigo, are you satisfied with the answer? Okay, I think he
Hello?
is. Okay, Mr. Humble, it seems like you have another question, but I will implore you to make it quick because we are coming to the end of our
Yes.
session, please.
I will not waste time. I just want to be clarified in one thing. What of a situation, sir, on the question I asked before? If
Okay.
the assets, the business is not the original owner of the asset, the government lease the company to us. Let's assume that government of Lagos State has a business and they
Okay.
cannot maintain that business again, and they decide to lease that business to an organization.
Okay.
What in that scenario, what will happen for replacement of those assets?
Okay. Remember that the definition is the asset that we want to define as asset must be owned or controlled by an entity. Now, the agreement on controlling the asset, we have a lifetime span. Maybe Lagos State handed it over for you for 10 years, for 5 years. Now, if you are replacing, you are putting into consideration the expiration of your agreement. If you know that the agreement is 1 year, you don't want to replace an asset in 1 year. I don't know if you get my point. So if you sign an agreement with Lagos State to say, okay, this business is not productive, maybe because it is of our bureaucracy, you are a private owned person, come and help us run this business for 10 years. It will make economic sense for you from year one that you take over the business to quickly look for assets that are fully depreciated or they're not giving you maximum service to fix them so that you can start getting more revenue, more income from the year one, that from the get-go. But towards the end of the year, that you know you're handing it over to them, you may not care much about replacing the asset because replacement come at a cost. You agree with me? So if you take it over for 5 years,
Yes.
you scan through, you see that this asset is not giving us the best benefit. You have used the best of it. So this one you want to replace, that one you want to replace because you know that you are in charge for the next 5 years and it's going to generate economic benefit for you. But towards the end of your agreement, if you are not planning to extend, you don't want to replace unless it is a must. Maybe the asset is such that is critical. I mentioned critical during the class where I said some assets when they are down, the total business is down. Like if your asset totally depends on a generator, if the generator is messed up, you can't do jack, nothing you can do. So that kind of asset, you must find a way to make it to be up and running. Because when the asset is down, everything depends totally on it. So if you are in charge of an asset, it is still following that definition of you are controlling it, you do not own it. So because you are controlling it, you want to be sure that they are giving you the optimal and efficient output. So you want to change the one that is due for change. You will have books to guide you. When did they buy this asset? Has it been fully depreciated? The people from the production department will complain to you that, "Oh, God, no matter the effort you put, this asset is not producing more than 200 and it has a capacity of doing 500. So you call people to come and check, and they say, "Oh, God, this thing has outlived its lifespan." Either we change major components or we replace it. Oh, so if we replace it or we change major components, it's going to give us 400 per day output. If they tell you yes, you want to do that, especially when there is a sales for your production. You know that you are getting 200 and you are selling everything and you have large demand. So you want to increase the production capacity to be able to make more money. And remember the definition, the asset is going to generate positive economic benefit. So the purpose of replacing is to get more income. So if you have a long contract to run that business, because you are the one who is now controlling it, the ownership of an asset can be owned or controlled. So you are in charge, you deem it fit to replace to have more economic benefit.
Okay, thank you very much, Mr. Theophilus, for your answers. And I think at this point, there are no further questions. We are already out of time, and we need to round up the session. So once again, on behalf of the Young Legal Professionals Club, I extend my sincere thanks and gratitude to Mr. Theophilus Ewupeba for giving us a second session on financial asset management. This is the second time we've had you in the space of, I think, 3 months. And we are very grateful for you to take out the time to break down these very technical concepts and technical terms into very understandable language that we legal professionals can understand and can translate in our relationship and in our transactions with our clients. We're very grateful to you. Also, thank you to everyone who has been with us on this call. Thanks to those who are also going to watch this session on YouTube. The slides from this session is going to be disseminated to those persons who signed up for the event. And if you have any questions, any follow-up questions, you can always send us an email. We will try to see how we can get your questions across to Mr. Theophilus, who would and we'll see how to get the responses back to you. So on this note, I bring this session to a close, and I thank you all for your time and your patience. Have a wonderful day.
Thank you. Thank you. I wish you one of the best weekend you will ever have. Do have a nice day.